G'day everyone, welcome back to Pete's Investing Updates. We review the weekly progress of some key share market world indices and gold. In this week's summary, we focus on some key world markets and how they're reacting so far to the Evergrande crisis. As I said in my recent videos, there will be consequences from the collapse and debts owing by Evergrande and how the Communist Chinese Party will likely force the Chinese banks to bail out Evergrande. However, there are now signs of other debt occurring in other industries such as the key tech giants in China, who have also seen massive declines in their share price. The poo show is only just beginning. If you want me to review an index or a commodity, put in the comments and I'll cover it in a future video. As always, click on the subscribe button, the notification bell, and like the video to support the channel. Let's review the channel's playlist first of all. This will review the indices, the blue chip share reviews, and also the strategies we follow. And in there you can see the simple trading strategy, the average down process, and some money management ideas. We're not offering financial advice. We're simply providing some educational guidance in terms of trading and investing on the charts. There's not much fundamentals happening here, so we're going to leave the fundamentals to the news reports. We're just simply looking at the chart patterns and how to trade and get the best results on that. A couple of things to consider. We track and trade on a 15-minute chart. But also daily charts, and in this example we're going to show the daily charts today. We track and backtest revenue or over drawdown requirements as a percentage. This is to optimize our returns with less exposure. We backtest, transact with 5 contracts per trade. In the data I'll be showing you, that's been trading with 5 contracts for each index. So if you want to increase your revenue, simply increase the contracts, or to decrease your revenue and also your exposure, please decrease the number of contracts. Lastly, dividends are not included in our backtesting, so anything we gain there can be added to the bottom line. So let's get started. So first of all, this is as of today, the index results. So these are the indices we're tracking, including gold, and what margin is required per contract when trading these. This is our testing logic, the entry criteria, the average down process, and the exit strategies. This shows the revenue since 2007. We're tracking these on a daily chart. It shows the revenue generated since that period and the maximum drawdown. That's simply taken from the highest point of profitability down to the lowest point during that period in terms of what sort of exposure was needed. And this simply calculates out on a per month basis on average if you took that divided by 176 months based on today's date. That's in comparison, we're down about $1,000 compared to the previous results published on the 19th of September. So again, we're up, we're down actually from 348,975. Previously we're 349,974. That was the previous results. So we're down about $1,000 since about 10 days ago when we last published these results. So I'm trying to keep these consistent and also consistent for these indices to help track it. So let's look at each of these markets and how they're performing and what sort of patterns are occurring and what to look out for. So first off, let's look at the Australian market. As you can see here, it's reached this point of support. Just get rid of some of these, clean it up a bit. So it's reached this support level, and this is the moving average 200, this black line. And if you go back further, you can see here during the start of 2020 when COVID hit, that's the effect it had. If you go back even further, that's why I started back in 2007. You can see the effects of the GFC crisis and how that impacted our profitability. So again, from that high there, this is the profitability chart. From that high to that low, that's what's considered a drawdown. And that would have been the biggest drawdown on this particular chart. And just using this as an example, again, our trading strategy, if you refer to the entry criteria and exit criteria and the average down process, feel free to freeze the video to accumulate and to absorb that. But that's basically looking at, we enter the market when the CCI 14 breaks above 0, and we exit, and that's what these spikes indicate. Just a little indicator I use to help identify that, to make it a bit clearer. So if you look at this point here, we enter the market there, 5 contracts at 733.4. We enter the market when the CCI 14 broke above, and we continue on. Now, we don't exit the market. We need to get a minimum profitability, and that's what this dotted line down here is. It reads the overall high-low average of the last 100 bars, or 100 days in this case. So it calculates that on every day. So what it basically means is, if you look at down there on that on a dotted line, what it says is 787 points is what it needs to achieve minimum before you exit the strategy. So in this case, we haven't reached that minimum point gain. So the market then dropped off. So we're still in the trade on that one. That's where we entered the trade there. Whereas here, you can see there it entered the trade there, fluctuated a bit, then it started rising. And then when it hit our minimum high-low range of the last 100 bars, it exited at that point there. And the exit criteria is when the moving average 20 becomes negative. So now the moving average there became negative there, but it didn't close out because their minimum profitability wasn't reached, but it did close out there. So again, we don't want to close out with a very minor or negative profitability. We want to have a reasonable profitability. And we use the average of the last 100 days, average of the last 100 bars to get that. We could have used an arbitrary amount of 5% gain, but that 5% can be subjective depending on the time frame of the chart you look at, and also the instrument you look at. So we want to try and be consistent. Say, okay, what is the average of this particular chart, the average high low of the last 100 bars? And we use that as a benchmark to then track and get our minimum gain. So that's the ASX. Let's run through these very quickly. We look at the US market. You can see there it's bouncing off this moving average 200. It's sort of tracking against that. It's going quite nicely, but very similar to the ASX. It's reopened again a few days ago, another contract position, whereas it did close back there. So it's opened up another position there, but we're in a bit of a decline now with the moving average 20 in decline. Let's look at Germany. Similar to the American and the Australian markets. I won't talk too much about that. The FTSE. I want to try and keep these videos pretty tight and concise. So again, very similar to the other markets we've seen so far. And then finally, let's look at China, which is our biggest challenge at the moment. So you can see here it's bouncing off this support line, and that's the one driven and by the software here I'm using. But also look at this downsloping triangle. These are the lines I drew. It's sort of bouncing in that area there. Now it's probably going to come back and hit off that resistance line there, but keep an eye out. It may actually come back down and fall further. So there's still a bit of uncertainty in the market. It's a bit of a double bottom or a triple bottom there. It may well break above that, and if it does, it's a positive, but I'm not holding my breath. We'll see how that performs. And then lastly, let's look at gold. Gold hasn't appreciated as much as we'd expect in the current climate. You would have thought gold would do a lot better, but that's still going pretty much sideways all this year and most of last year as well. So I hit a bit of a peak there, but it's dropped below this resistance line there, and it's actually not doing as well as you would expect in the current negative climate. So again, just looking at the results, all these figures in terms of profitability have dropped from the previous results. The only one that's gained is China. So back in the previous results was 89,022, and the current result is 90,500. And again, that's based on the data since 2007. So again, China's the only one. The China market is the only one that's bounced. All the others have declined. Hence, our profitability has declined for all of them except China so far. Now again, don't forget to refer to the margins required. Obviously, the bigger the margin requirement, the bigger the profitability, but also the bigger the risk. As you can see here, gold, very small margin requirement, but also very small in terms of the 5 contracts we're trading, very small revenue generated compared to the others. Anyway, don't forget to hit the subscribe button, the notification bell, and like the video, and we'll speak to you guys in the next update.